Welcome everybody to another town hall, a coronavirus town hall brought to you by Multifamily University. We are thrilled to be with you. This is Saturday, April 25th. And we are, how many days are we into this pandemic? I think it depends on where in the world you are. I mean, I think I'm on like day 46 of lockdown.
Is it that long?
Yeah, California, Bay Area, we were like ahead of the curve, on that.
So when
anyway, I'm here with Omar Khan, Victor Menasce, and Neal Bawa, and I will let them each intro themselves. And we're here today to talk about coronavirus, where we stand, and specifically about multifamily syndication. We've got a group of questions that we've prepared, kind of pre-vetted, and then we will also be taking questions from the audience, so you can type them into the Q&A box, and we'll try to get to as many of them as we can. So to start out, let me just go around the circle. I'm not sure how the circle you're seeing on Zoom, but I see in the window below me, I see my friend Omar Khan. So Omar, can you do a no more than 30-second intro and then pass it on to Victor?
Hi, thank you very much, Neal and Anna, for having me. And hey, Victor, great to talk to you and see you again. My name is Omar Khan. I'm the founder of Boardwalk Wealth. I come from the institutional world. I structured a lot of deals in oil and gas, finance, and now I'm in real estate. We've done a couple of projects in Texas, Florida, and Georgia, and specifically the last two projects were with the Grocapitus team, so very excited to be here.
Victor?
Well, good morning, Victor Menasce here. I'm the host of the Real Estate Espresso podcast, a daily show 7 days a week, and author of the book Magnetic Capital, also one of the principles of South Lake Development. And we focus primarily 90-95% on new construction, a lot of it in multifamily. We have an assisted living project under construction. We've got a hospitality project that we are entitling right now. So we're busy with a lot of projects and trying to make sense out of everything that's going on here. So glad to be here.
Thanks for being here, Victor. Neal?
Neal Bawa. I am a recovering technologist that accidentally ended up in real estate. I'm the founder of Multifamily U and Grocapitus, and even though I'm a syndicator, I feel like I'm an accidental syndicator. I think that all I am is a person that's trying to read the tea leaves, understand data trends, and see if I can apply those trends to make money for my investors. And if today that ends up being syndication, then so be it.
Well, there you go. I'm Anna Myers. I am the vice president of Grocapitus and business partner to Neal Bawa, and somehow asset manager of 12 projects that are in the middle of coronavirus, but we are, I'm proud to say, doing very well. We're fighting the good fight, and I'm proud of the work we're doing. And we're here to talk about multifamily syndication, and we're going to start out with, and underwriting and all that. We're going to start out with, let's just have a question, and this is going to be for everybody here. What do you think in terms of the big V or the big U? Where do you think we're going with this in terms of recession?
Who wants to go first?
Well, why don't I go first? I'll start with where I think we are and then what it'll take to get us to the other side of it. I attended an invitation-only webinar this week with the chief economist for Royal Bank and a senior vice president from Royal Bank. And it was strictly for their private banking clients. And they shared some data from what they see within the bank, because as Canada's largest bank, they get to see a lot of transaction flow. So what they shared was that Visa and debit card transactions in the first couple of weeks of April are down 60%. That's 60%. And after a flurry of people binge buying on groceries and toilet paper, even revenues at the grocery store are down about 11%. When they plug those numbers into the model for the economy, they look at a 32% contraction in the economy in less than a month. If you compare this to the Great Depression, where there was a 26% contraction, it took 4 years to get there, and we've done it in 4 weeks. I don't think there's a big difference between Canada and the US, frankly. I think the numbers are going to be remarkably similar, and they shared some US numbers that were pretty close. We're looking at 74% contraction in restaurant sales. We're looking at 53% contraction in household goods. We are looking at 9% occupancy in hospitality right now. That's kind of the lay of the land where I think we are. And I mean, you know, you all read the headlines, but this is maybe a layer below the headlines. My feeling right now, when it comes to the question of how long, and I'll share with you some math, and I hope my math is wrong. I really do.
I've heard that before.
Yeah. What I'm worried about is, of course, what everyone's worried about, which is the healthcare system. And, you know, when will the healthcare system get crushed? Arguably, we have, I don't know, if you look at some of the European numbers, somewhere between 1% and 2% of the population being infected with COVID-19 after several weeks. And that's crushed the healthcare system in Spain, in Italy, in parts of the United States. Maybe we're wrong. Maybe the infection rate's a bit higher, but it's going to take a period of time to get to one of three things. Either herd immunity, which will happen at about 85% of the population getting it, or a vaccine, which is 18 months away at best, or an effective treatment. It's one of those three. So basically, we are in this lockdown phase so that we don't crush our healthcare system until one of those three things happens. My feeling is that if you allow 1% of the population to get it per week, assuming you could even do that, we're looking at about another 80 weeks of this. That's a year and a half. I hope I'm wrong. I really hope I'm wrong.
You want to jump in on that math,
It's just the
Neal?
math, right?
Yeah.
Math, right?
I don't think that there's a chance that Victor is wrong. I think that at this point, anyone that is hoping for or believes in a V-shaped recovery is being debunked. The chances of a V-shaped recovery, in my mind, at this point are zero. And now there's evidence. You can look at China's economy. When China reopened, we started looking to see how much coal they were buying, what was their electricity usage. We started looking at traffic counts. And I can tell you that normally when we go into a recession, these things decline by 2%, 3%, 5%. So here's China fully recovered with 15 or 20 cases per day in a country of over 1 billion people, right? And they've got the healthcare system fully ramped up so they can afford to let loose a little bit. And we are seeing their electricity count run at 80%. Now, 80% represents far worse than the 1929 Great Depression, right? So 20% of their productiveness has been lost after they came out of shutdown. And when I look at that and I say, the chances of that being called a V only happen if you actually never went to kindergarten and rode a V, right? You don't know what it looks like. So to me, that is a zero likelihood. Now, when you look at the U says you go straight down or almost straight down, then you kind of hang around there for 80 weeks, let's say. We use Victor's example, and then you go sharp back up. I find that to be even less likely, because the damage that this will do when you go this sharp down and then hang around for a long time, the damage that it does to the world economy is so massive, so unprecedented, so unlike anything that we've seen since World War II. Then to have the ability to just all of a sudden shoot back up it would be a feat that has never been seen before in any kind of recession recovery that we've ever seen before. So the chances of a U, in my mind, are even lower than the chances of a V. So what we are in, hopefully, is something that is either called a check mark recovery. So it's it's not it's like the left side of it is like a V. So you go down like a V, but when you're coming up, you come up much shallower than that. And in my mind, that shallowness is 3 years long. I was thinking it's 2 years long, but when I read the reports of the amount of damage that we're doing, the fact that the Federal Reserve of the United States is trying to buy junk bonds tells me how worried they are. Junk bonds? Really? I mean, corporate bonds are one thing, but buying junk bonds tells me that they believe that they have to basically hold up every portion of the economy. So in my mind, we're in a V. That check mark is a 3-year recovery. And some people call that an L-shaped recovery, but it's going to be very long. It's going to be extremely painful. The other thing is, I don't think that it's, even if it's a check mark, it's not going to look like a regular check mark. You're going to go up and then go down and then go up and then go down. It's going to look like a really weird check mark. And then hopefully we end up where we are today in 3 years or more.
Well, we're not going to have much of a recovery if we keep injecting ourselves with Lysol.
That's
per
right.
the latest thing. So,
They're going to make tabs. I mean, Omar, you can just take pills of Lysol.
Look, without even going to this Lysol thing, but I'm going to go there. I'm just surprised we're living in a time where a major manufacturer has to come out and say, please don't infect yourself with bleach.
Please don't drink bleach to try and
That's right.
We're living in such a weird time where things like this are happening. So look, how long the recession takes, frankly, it's everybody's guess. Nobody knows whether it's a we, a Jack, a you. We can theorize about what effects are going to happen. But I think what is going to happen, what I don't personally believe is going to happen is, and I know Americans are obsessed with this thing, that hyperinflation is not around the corner. You have no demand. Nothing is going to happen. Okay. And I do think, a lot of people tend, in my opinion at least, a lot of people tend to criticize the Fed, but you're caught between a rock and a hard place if you're the Fed. Because if you let everything go to hell in a handbasket, there is a moral imperative that, the losses should be not socialized and privatized. I get that. But if you let everything go to hell in a handbasket, you're going to have a situation where even more massive social unrest happens at a much quicker pace, which is not at all going to be manageable. So where we do end up, that remains to be seen. I do think pockets of each country, or pockets of rather countries are going to react differently, and places like California that have responded much positively might come out of it. But this is at least a year and a half at the bare minimum in the most optimist scenario, like for you to come out to the other end.
Okay, so we've got a year and a half to 3 years.
And that's optimist, by the way. Year and a half is very,
Yes, understood. Year and a half to 3 years we're talking about here. So now let's talk about, should multifamily syndication investors be worried about their investments?
Well, yeah, that depends on who you've invested with.
Okay.
Right, and what price you bought something at. Because right now, look, it all depends what price you paid for something, right? So if you paid a good enough price and you have, let's assume, good enough cash reserves or some version of that, you have a very good resident tenant base that's continuing to pay you rent, then you are not in as much for trouble as, say, somebody who bought at the peak of the market, tried to be cute and didn't have any cash reserves, and now they have a resident base, which unfortunately is not in a position to pay them, and they themselves don't have the chops to manage the situation.
Yeah, I'd say management plays a role too.
It's a management play
and asset management.
Yeah, it's all of that.
Very strong.
But it's also a case of the fact that, look, if you were trying to be cute and trying to cut corners, well, I mean, the day of reckoning is here, pretty much.
Yeah, especially with inflated underwriting that made your numbers magically work. That is going to be problematic right now.
And I want to jump in and say, it's rare for me to disagree with Omar, but I'm going to disagree. I think every multifamily investor needs to worry about every multifamily property. Because the problem is exactly what Omar described. My take on it is different. You've had a huge amount of properties where people have been cute. You've got a lot of properties that are not well capitalized. They're expecting that this thing is just an April and May thing, and in June everybody's going to pay rent. I think the chances of everybody paying rent in June are actually lower than the chances of the people paying rent in April, because this accelerates from here on. This isn't like this and coming down. This goes up and then stays at that level, that up level, for a long time. And as a result, you have a lot of tenants not paying in a lot of properties for a long time. And so I believe that, yes, everyone that has invested in multifamily syndications needs to worry about it, because I think the world just changed. The world just changed. The way the amounts that we expect to receive from tenants have changed. The rents have changed. The delinquency levels have changed. The cap rates for properties have changed. We just haven't figured any of this thing out, these things out yet, how much the change is. But to expect that any of the properties are safe is unlikely. To me, I think that doesn't matter how good an operator you are, you operated in this market, you bought in this market, you expected and accepted the assumptions of this marketplace today, and those assumptions are now wrong. And you may think that they're not wrong yet, but if you don't think so, then wait 90 days.
See, but on that point, does that mean you should be worried in the sense that you will survive this, or you should be worried in the sense that you will hit your pro forma? Because those are two very different things. I was coming from the context of the stronger players will survive this. Not necessarily they will hit their pro forma, which they promised to investors, say, 8 months ago. Because surviving right now, by the way, is going, if we go over this, say, if this takes a year, and people who somehow scrape and fight their way to survival, that in it of itself is a big achievement.
Quite possibly. Victor, what do you think about this,
Yeah.
the survival versus pro forma theory?
Well, so here's a perspective. If you as a single owner operator have a problem financially, then you have a problem and it's between you and your bank. When millions of owner operators have a problem, then the bank has a problem, the Fed has a problem, and the federal government has a problem. So the question is, what are they going to do to help? You know, where is this magic money coming from? Of course, they're printing it. And then who falls through the cracks? If you're FHA, if you're underwritten by FHA and the Fed's going to buy all this debt, okay, maybe it gets wallpapered over. If you're with a private lender or you're with an insurance company or a mortgage-backed security where the bond has no provision to even do a forbearance agreement, it's not as clear. So all these different forms of debt, the problem isn't, so, you know, I like what Ray Dalio said, I think about a week ago. He said, you got to look at this from two perspectives, income statement and balance sheet. Mm-hmm. And sometimes what's being offered is a balance sheet solution to an income statement problem, or vice versa. So, you know, reserves are important, but nobody's sitting on 2 years of reserves, just nobody, not even, you know, 0.1% are sitting on 2 years of reserves. Prudent operators are sitting on 3 to 6 months of reserves, and we've got a bigger problem than 3 months, clearly. So it really is going to come down to how does what is the fiscal stimulus, what's the monetary stimulus going to be, and where is it going to end up, and who's going to be the beneficiary of it, and who's going to get left behind. That's a critical question. I don't think any of us really have the answer to that yet.
Well, I'll jump in and talk about fiscal stimulus, monetary stimulus. I think that you're going to see an absolutely unprecedented level of stimulus.
Yeah.
You're going to see, I mean, we thought, oh, $2 trillion, that's a lot. No,
Yeah.
My belief is you're going to see more than $2 trillion in the next level. You know, we just released like a $450 billion package. That was really part of that first set, right?
We've run out of that 2 trillion thing, by the way, just to let you know.
Yeah, we ran out of $2 trillion. The $450 billion we're supposed to run out next week, right? So we're supposed to run out of that in a week based on the existing applications that are in the queue. That all of that is step one. In my mind, step two was going to be bigger than step one, and step three is going to be bigger than step two, because what we're doing is the damage done here is so massively colossal that what the Fed is doing is basically running the economy, right? And Congress and Fed together are running the economy because we've shut it down. And when it restarts so painfully slowly that we have to run the economy through fiscal stimulus and monetary stimulus for a very long time. So, I mean, I saw this, CNBC did a poll where they said, what percentage of people after shutdown, finishes are willing to go to a restaurant? What percentage are willing to go to a ball game? What percentage are willing to, to go out to a movie theater? And I can tell you all three of those percentages were really, really low. The share of people that are willing to do that is very low. When I looked at the chart this weekend of Beijing's traffic, Monday through Friday looks pretty normal. It looks at like well over 90% of normal Beijing traffic. Saturday and Sunday look like there's a curfew of some kind. So when people can go out, they're choosing not to. And so as a result of it, I think you're going to see an economy that looks worse than the Great Depression for months on end. And I think that's going to hit all of the multifamily collections. We're going to remember April as the good month. And I think May not get much worse because there's so much stimulus coming in, but I think June will get worse, and then July will get worse. I don't think that July looks better than May or April. That's my belief. I think
one of the brokers told me, oh, that's a nice.
Oh, there we go.
I'm going on a cruise. How's that?
All right, you're going to be the only one there, right? So it's like
you got the whole place to yourself.
Cruise.
Victor's cruise.
Look, one of the big brokers out of Atlanta, the Cushman guys, they were joking with me and said, look, the April, May, and June internally, they're calling it the good, the bad, and the ugly.
Oh, there you go.
And July is going to be, I guess, uglier or ugliest. That remains to be seen, but you're right.
July is foggy, right? Because you don't know how the world is going to take this over the next 2 or 3 months. But I think, April, May, and June, good, bad, ugly. I like that. I'm going to steal that, guys.
Yeah, and one thing I wonder is how are people going to pivot? Because there's individuals that are being affected by this that worked in restaurants and worked in service industries that are being shut down. And yes, they may be looking for stimulus money, but these are human beings that are very creative and smart. And what opportunities are they going to now go into? There's all kinds of new online jobs and opportunities out there. I think people out of necessity are going to change their jobs, and that could have an effect on what's happening in July. And going into the summer is we see a transition of the job into different types of markets and opportunities that are online. People are going to help dig themselves out of this. That is my hope. I'm an optimist. I'm an eternal optimist.
Yeah, I agree with that. I think one of the things that's definitely going to happen is as employees get separated from their employers, the path to them getting rehired is much, much slower. So
Yes.
what some countries in Europe have tried to do is paid the employers to pay the paychecks, even if those folks are sitting at home, but ensuring that people don't get separated from their employer so that the restart happens faster. We're not doing that quite so much here in the United States. I mean, the payroll protection program is attempting to do that to a degree.
It's a joke.
But it's relatively short term.
Yeah.
The answer, the key word that Victor, you didn't put in there is yet. I think we will be forced into that. It's just a matter of time.
Yeah. Well, how has the multifamily acquisition transition cycle changed because of this? And how are we going to value assets going forward?
Well, I can take that. First of all, there's no deal flow right now. So, for instance, or rather, if there is a deal flow, as an example, as in the contract didn't start before this coronavirus thing, right? The contract negotiation sort of thing started after. Yeah, this person is under deep distress for them to be even contemplating trying to sell in the middle of what is arguably an unprecedented time, which is frankly nobody right now. Let's just be honest. So there is frankly no deal flow. Now, some of the deals that have closed were deals, let's assume, that were agreed, consummated, and let's assume $1 million of hard money is put up and they already raised 90% of the money. So yeah, those deals are slowly trickling in and closing. What I have heard and what I'm talking to brokers and just other owners as well is basically people are now putting in financial contingencies in the sense of, hey, will I get a loan, not get a loan? And, timelines associated with that. Hard money, I guess it's there, but it's not really there. I mean, it's one of those things where it depends on the attractiveness of your asset, but it's not really there for C-type assets, right? Mm-hmm. And then basically, you're also saying that it's on a good faith basis, basically. So good faith basis, what does that mean? That means that if you've transacted in the market before, people know you, brokers, owners, all of that sort of stuff, there is more faith in you to perform. Then let's assume you are a newer person with not as established a track record, whereas even like 8 months ago, you could come in and guns blazing with the money and, people would kind of sell you the asset. But right now, that's not really going to happen. And on the debt side, to be very honest with you, I keep hearing about people talking debt isn't available. Guys, debt is available. It's just on terms that you might not like, but it's available. I mean, so there's no financing issue right now.
I think it also goes back to that resume and that experience and network that you're talking about too.
Yeah.
Those that have better availability to debt right now are ones that have a strong resume and strong connections and have proven themselves to these lenders over the years that they can perform. So they're going to have better rates than people that are new.
But it's available. Let's put it this way. It is available.
Yep.
It's not like the world has ended right now. The problem for a lot of folks might be that, or rather is that sellers' expectations and buyers' expectations are very different right now. Like a buyer is going in thinking, oh, it's coronavirus, the world is ending, I'm not going to be making any money for the next year. Here's what my, crystal ball says. And the seller says, well, look at my April collections. I'm not pushed. I'm going to just punt this down for another 30 to 60 days.
Yeah, there's been a big disconnect.
Yes.
Neal, do you want to jump in on that?
Yeah, I think other than 1031 transactions, the $1 million hard type transactions, there's nothing happening in the marketplace. I mean, there's no reason for anybody that doesn't have to sell, so they're not pushing to sell. And the people that are looking to buy don't even know how to value it. In my mind, until Fannie and Freddie come out with a set of guidelines, there is no way to value multifamily today. I mean, those guidelines have to say specific things like, well, when we look at the the cap rate of a property, when we look at its ability to hold debt, we're going to simply ignore what happened in April or May in this property. They have to say something like that. And why would Fannie or Freddie say that, right? It's
Right.
not to their benefit to say that. But until they do, I think the market is frozen, which is why you're going to start seeing cracks in the marketplace over time. You cannot have a marketplace that's, you know, hundreds of billions of dollars be effectively frozen for months on end because nobody knows how to value anything. So I think that the quasi-government agencies are going to get pushed to start issuing guidelines, because also Fannie and Freddie they need business. They can't have tens of thousands of employees sitting there with no business at all. CMBS doesn't even exist today. I mean, I have not seen a CMBS loan at all. So in my mind, the real game in town are local banks at the lower level and Fannie and Freddie. And people have to find some way of measuring the value of assets. So I believe that within the next 60 days, you're going to start seeing governmental agencies and banks issue some kind of guidance on how it is that we're going to look at the damage being done in April and May to the rent rolls, and how are we going to value properties based on that. Until that happens, I expect the market to be just frozen.
But I also think, look, the longer it persists, eventually, whether people should or shouldn't, but it's a mental game also, right? Eventually, a lot of people, like, let's assume, God forbid, let's hopefully this doesn't happen, but God forbid if this does happen, say persist into July, right? And month on month, we keep seeing this like 3% decline, 5% decline in collections, 10% decline, right? Because the longer it goes, the more your declines will fall, collections will decline, right? I think a lot of sponsors, even if they have the financial capacity, will mentally start tapping out. Mm-hmm. Like they just cannot take the pain, because it just stops being it stops being a financial game. It starts being a mental game, right? If you can't go to sleep at night, you know, different weird things start happening, right? You start fighting with your partners. 3 of the 4 partners might want to sell. You know, those sort of dynamics also start coming into play.
I think Omar is absolutely right. I think one of the biggest things that we are all dealing with, and we have a shared experience here, all of us in North America, all of us around the world, it doesn't matter whether we're a landlord or a tenant, an investor or a lender, we all are looking for one thing, and that's certainty. And you can't find it. And, you know, people are inventing stories in their own head in order to create certainty where none exists. They are lying to themselves. They are saying, oh, it's just the flu. They're doing all kinds of different things just to manage their own emotional state and somehow deal with the uncertainty. Investors, like anybody else, look for certainty. Lenders look for certainty. You know, some lenders want a year worth of seasoning. Well, we've done this in a month. We've got to re-season all of these investments with the new normal before we even have a shot at valuing them.
Yeah. Well, Victor,
and lower LTVs. I mean, they don't just want a year of seasoning; they want lower LTVs. So to me, between the year of seasoning and the lower LTVs, the market is completely repriced.
See,
right?
Yeah, but see the lower
and repriced
LTVs,
for what NOI? Nobody knows.
Yeah, but see the lower LTVs is you're going off current prices or pre-corona prices, right? If the lower LTVs actually do result in lack of transactions, then presumably the purchase price has to go down, so that LTV thing can keep bouncing around within, you know, reasonably acceptable normal circumstances or ranges.
Well, the other thing that affects the price, of course, is the bid. So a property that has 20 offers on it clearly is going to sell for more than a property that just has 1.
Ooh,
yeah, of course.
And so, go ahead.
Victor, I was just going to move on to the next question. Which asset classes do you expect to thrive? We've been talking a lot about multifamily. What do you expect to thrive in the post-COVID-19 environment?
Refrigerated warehousing.
Yeah, you're right. Industrials are on a tear, by the way.
Refrigerated warehousing, because I take a non-real estate approach to this. I take a very business approach, which is the business is all about solving problems. And so where are the problems going to exist? And I'm not talking about the problems that fall in the luxuries or the vitamins category. I'm talking about the real acute pain type problems. We will see food shortages. I'm absolutely convinced. Just like we are seeing supply chain disruptions in all kinds of different industries, we are seeing the supply chain disruptions in food. We are going to be rethinking a lot of those supply chains and looking at a lot more at growing local, at supplying local. all of those transportation networks that have assumed global commodities where, you know, a pound of sugar price is exactly the same in Portland, Maine as San Diego, relies upon transportation.
Yes.
And if those transportation networks are disrupted, which clearly they are, you know, airlines are not going to fly the cargo belly of a plane full with the seats empty on top. It's just not happening. So we are going to see massive supply chain disruptions, and a refrigerated warehousing is going to become much, much more important in that story.
I agree. I was, you know, coming at this from a different perspective, and I agree with what Victor said. I looked at, so I went to Wikipedia, where there's a page that shows all real estate trusts in America by category, right? So hotels and multifamily and single family and student housing and senior housing. And I grabbed all of those and I sent one of my virtual assistants to check the pricing on each of those categories and each of those REITs on Feb 20th, which was the peak, versus what it is today. And I wanted to see, what does the market think about this question, right? And the answer is that you at the very top, you've got, you know, the ones that are hurt the most are, you know, typically the hotels and the senior housing. Senior housing is hurting a lot because people want to take grandma out of that senior housing home because, you know, and they want to just stash her in the basement at this point in time because they're so terrified. On the bottom end, the areas that are predicted to do well are self-storage, industrial, especially tied to logistics and, you know, moving stuff, right? So there's different kinds of warehouses. The ones that I think are going to do well are the ones that are tied to moving stuff or storing stuff. And then you had single family, you had apartments, but apartments were not as low and not even as close to being as low as the single family REITs. And why the single family REITs doing well? Well, because the market understands that the person that rents a single family home has more money and more cash in the bank than the person that rents a Class B or Class C apartment. So interesting enough, the Class A apartments are doing better at this point of time.
Right.
Because they've seen very little delinquency. I looked at the delinquency statistics from Marcus and Millichap and CBRE, and the ones doing the best clearly were Class A. Class B was pretty decent. Class C had significant hit. I mean, it took a very, very significant hit in collections for April so far. And so when I'm looking at that, I'm looking at the REITs, and actually it is the premium housing REITs that are doing well as opposed to the lower end. And single family REITs are premium housing, right? So if somebody wants to rent a single family home, they're going to pay a lot more than an apartment because they have a lot more money in the bank. They feel more confident about their ability to pay that rent. And so those are the parts of the market that are definitely going to do well. I think we're going to see a bloodbath and a massive wave of defaults in retail and also in hotel. But I think that if the economy reopens, you're going to see a bounce back in hotels. But I don't believe a lot of that is tied to travel and necessary travel and things like that. But I think retail, a lot of those people were weak. A lot of those retailers were already operating at 2%, 3%, 5% margins. I think they just go out of business. So you're going to see a massive wave of defaults in the retail business. And that's going to take the mall and the shopping operators under.
Yeah, the physical retail, a lot of the retailers that were online and successfully online are in a much better situation than those that were like just dabbling with online and hadn't gone there yet, because they're still able to sell. You know, but that doesn't speak to the physical space of retail. Yeah,
I do think that Victor has a great point with the refrigerated storage. I think that's an area where you might see shares going up. Everything else, I mean, we've still seen shares go down. Industrial stock is still down. It's not up, because how can industrial demand go up when demands of all kind is being demolished, right? But they may do better if you want to hold for 2 or 3 years. You might see you're going to see a bigger profit there. But at the moment, I think the only thing that demand is going up for is refrigeration. The other area that's doing well, which by the way is not part of the real estate arena, is oil tanker stocks. I mean, right now they're up 4x, 5x because oil tankers have turned into storage.
Yeah, storage of cheap oil. Absolutely. So let's see. Let's talk a little bit about construction and how are construction projects being impacted.
Maybe I can jump into that because I have 3 or 4 of them going, right? So, so far, bizarrely small amount of issues. I mean, and I was really afraid for my construction portfolio. I felt like that's where our biggest exposure was. I can't say that 45 days into this, that's where our biggest exposure is at this point of time. So we've actually seen it easier to build. Our project in Dalton, Georgia, which is one of the states that considers construction to be essential, is actually ahead of track. We're now, Anna, are we 6 weeks ahead of track?
We're 6 weeks ahead, yeah.
And a lot of that is because they find as many workers as they need, right? So there's a lot of non-essential construction that stopped. So workers need cash, and they call, you know, the general contractor, and so there's more crews available.
Yeah,
so if you're right now
crews.
framing something, well, good for you, because you've got as many framers as you possibly need, probably at a lower price than you were paying before. Our project in St. George, same thing. I mean, construction's going gangbusters. The problem is going to be if you haven't locked in your loan. If you haven't locked in your loan, if you haven't locked in your equity, you are in very serious trouble on both of those, especially if you're building something large. If you're building something smaller, I find that the loan market right now, the lending market, is very liquid for smaller projects, but it's very illiquid for larger projects. Also, the equity market is illiquid. One of our projects, you know, we'd already sold the project out, but we hadn't taken all the money, and some of those investors jumped out. So we had to basically refill the project, sell the whole equity, you know, project again, or part of it, and that was a painful experience. But other than that, construction actually has benefits because you're not delivering anything for a year, right? So let's say you're delivering next year in July, you're in a good place. If you're doing student housing and you're delivering for next year's August session, you're in a much better place, because I think contact tracing is going to be in a much better place for next year's August session than for this year's August session, right? So I think it depends on where you are with construction. You could be in a really difficult place, or you might be just fine.
Right. And location obviously matters hugely on that, because
Yes. And Victor, I mean, I know you're in construction. I'd like to know what your thoughts are there.
No, I agree with everything you said. We've got one project in construction right now, and crews are definitely available. There's a little bit of concern about materials. You know, for example, 90% of the doorknobs manufactured in the world come from China. And so if you're looking for lock sets and hinges, you might have an issue. So there's a few things that we're having to pay particular attention to sourcing.
Mm-hmm.
We have a couple of projects that are shovel ready that we have put on the shelf for exactly the reasons you talked about. And we have one that is going through the entitlement process, and we're saying, okay, let's slow that one down. There's no need to rush it at this point, which, you know, is both good and bad, of course. But it's no different than, look, you're basing all of the assumptions on these projects on things that happened 6 months or a year ago. You know, you've got immigration, you've got assumptions on immigration, you've got assumptions on incomes, and all these things that right now are frankly out the window.
Yeah, very true. Very true.
Now, you made a comment about assisted living and senior care.
Mm-hmm.
One of the things that we've seen, you know, there was a headline on the Wall Street Journal this week: 10,000 people have died in senior care in the United States so far since the start of this pandemic, and it's absolutely tragic. There are a few different classes of senior housing, and so it's beneficial to break that apart into a few different asset classes.
Yeah.
The big box facilities are the ones where you're seeing these big outbreaks. The ones where you have high ratios, 12 to 1, 15 to 1 patients to caregiver, they're in real serious trouble. We have been investing in residential care and actually building planned communities of residential care where it's 12 to 16 residents per home. Each resident has their own bedroom, their own bathroom. The ratio is 4 to 1, 5 to 1. We haven't had a single case, zero, in those types of facilities. So those types of facilities, people are saying, well, do I bring mom or dad home? Well, yeah, but you don't have the facilities to take care of them. They're in assisted living or dementia care for a reason. Maybe there's another alternative. There's maybe another asset class that's a subset of that space that might be a better fit. I think those ones are going to do really well, actually.
That makes sense. The devil is always in the detail.
The demand is still there, right?
Yeah.
That's absolutely true. So demand supply fundamentals and their impact by market and product type. Omar, you want to dive into that for a sec? Class A, Class B, Class C. What are you seeing there?
Well, in the markets we're active in, there's lots of demand from buyers still, right? But their expectations are slightly different than what the sellers are willing to trade at.
Yeah.
There is still some supply. Actually, there is supply. It's just that a lot of sellers right now have taken their product either off the market or they're shopping it off market with the expectation that they can kind of just sell it at a pre-corona or with a slight haircut, right? Because like we said earlier, there's a disconnect between expectations because the buyer is looking in the future, the seller is looking in the past to make their valuation judgments, and that's a world of a difference. Now, Class A is still going fine. Typically, also Class A also has more deeper pocketed investors with with a big ample war chest. So they are going to do. I think that fine is a bad word to use, but they're going to be okay-ish. Class B, B plus-ish, like the Equinox at Night deal we did. That still there's going to be some level of demand for it. Whereas is it going to be 20 people like it was 6 months ago? No. But Class C is going to take a bloodbath. Either a bloodbath or sponsors have to realize, look, we've got to reconfigure our entire operations, and we have to have these painful conversations with investors to tell them that not every person who took a weekend course at the Sheraton is now going to triple your money in 2 years, right? So that's basically what's the case in the bigger metros, right? And bigger metros, I mean, in the areas we're at, Texas, Georgia, Florida. Now, with regards to, I think the bigger aspect for people is going to be that a lot of folks are going to run into the equity portion of the capital stack. They will not be able to raise the equity at a pace in which they can actually close the deals or which will be agreeable to parties. So I think that's an issue, more of a concern, but that is basic blocking and tackling that you need to be doing with your investors anyways, even if you don't have a deal.
Okay.
Class C equals bloodbath. That's my belief as well.
Yeah, look, if people don't have money, how are they going to, we've had this conversation like lots of times, even before this Corona thing. Yeah. Like nobody to date has been able to explain to me, how do you get blood out of stone? Like if somebody doesn't have money, how are they going to pay you? And this was a conversation we've had years in the making, right? This wasn't just like coronavirus, because every Tom, Dick, and Harry in Texas seems to tell me Class C is like the heaven. And I'm like, man, have you seen this? People don't have money. Like, it's a bit like telling me to go buy a $500 million yacht. It's not going to happen, no matter how badly I want it. So yeah, there's my take on that.
I wanted to jump into some questions that are live from the audience now. We've got a bunch of them queued up, and it's about time that we jump over. Are you guys all ready for that?
Yep.
Right on.
We're going to try and be short and succinct in our answers so that we can get through more questions. Elizabeth owns seller finance properties where sellers aren't willing to do payment deferments with the banks. What advice do you have when it's not possible to evict tenants right now? So she owns seller finance properties where sellers aren't willing to do payment deferments with the banks.
So why can't she evict tenants?
So I think the best thing that she can do is talk with the lenders to see what options they have. Yeah. It really comes down to having conversations with your lenders. And I even urge those of you that have Class B and Class C properties where you have 3 to 6 months of reserves left, talk with your lenders. Talk with your lenders every day, because right now it's your relationships with your lenders that will matter. If the shit hits the fan, as we all expect it to, yeah, it's going to be your relationships. They're going to make decisions on that. So even though this is a seller finance property, I think you've got to be talking with your lender about, what is happening here. The best advice I can give you is find a way to extend this process as long as is possible. You need to play this long game. And I know it's a hard game to play, but you have to learn how to play the long game with seller finance properties.
Absolutely. In fact, one of the things to look at is to actually break it down a little bit further. I would be reluctant today to jump into any kind of forbearance agreement that says, okay, I'm going to get a 3-month payment holiday, but I've got to now make up that 3 months over the following 12 months. Not interested in that at all. But because the market's simply not going to support that. But if you sit down with your lender and say, tell you what, why don't I pay the interest and let's put the principal portion to the side we'll make it interest only until this clears. Now that's a much more supportable type of scenario. And yes, it's extending the loan. Yes, it's doing all those things, but it's not turning it into a toxic asset. That's a much easier conversation to have with the lender than saying, I need a 90-day holiday or something.
And I have a tip for that one. Actually, I love that idea, Victor, because you go sit down with your lender and say that. And my guess is 9 cases out of 10, or maybe even 99 out of 100, your lender in the end is going to say, no, we don't need to do that. You didn't waste your time, because you're going to repeat this process in 30 days, and then you're going to repeat this process in 60 days, and then in 90 days. And I can tell you your chances of success are going to increase each time as the pressure on the lender increases. Yep. This is about that constant conversation with the lenders, because the lenders are also beginning to realize, oh shit, we're screwed, right? But it takes them time to figure out just how screwed the lenders are. And so as time goes on, they're more and more open. I mean, in 2008, there weren't any loan adjustments, but in 2009, there were some. In 2010, there were millions of loans adjusted, right? So it takes time. Play the long game. And the best way to play the long game is constantly be talking to the lender.
So let's go on the other side of that. We have a question here, and there's a bunch of questions that are similar to this. This person's negotiating a PSA for a 40-unit building in this case, but lots of questions in the thread that are similar. The seller has become a lot more flexible lately, but does not want to touch the price. Do you really think we'll see a drop in prices in Q3 or Q4? But I guess the bigger question is, the seller doesn't want to touch the price. They're in a PSA. What do you guys suggest that people that are under contract
tell them to guarantee revenues for the next 9 months?
Okay, tell them to guarantee revenues. If
yeah,
they won't
like
touch the price,
to a year,
that's
right?
a great,
and
great
be like,
one.
Look, I'll agree to your price. You guarantee revenues for the next 9 months to a year. We hit those numbers. You get your price. I come out of this. We're all happy. Everybody's good. So,
I love Omar's idea. It's brilliant because basically it gives you a year of maintaining an artificial cap rate, even if the cap rate of the property is increasing, right? So you're buying, the seller's buying you 12 months of cap rate guarantee in a way. I love that. If the seller agrees to do that, you're in a good place. At least you've got 12 months of, not having to worry about the asset.
Yeah, and then you don't even talk about price, right? You say, look, we'll both agree with you.
Yeah, because if it's based on income, if they can guarantee income, then that's fair. Yeah, it's a great approach.
In my mind, if they don't agree to do that, walk away.
Yes, walk away.
Just walk away from that EMD. Just walk away. Keep in mind that you're not walking away from EMD because if your contract had a very basic force majeure clause, there's a lot of people now suing saying coronavirus is force majeure.
Yeah.
We were unable to perform. We were absolutely unable to perform. And I think that what's going to happen is that obviously that no court has ruled on this yet, but there's going to be a court ruling on it in the next month or two. And once there's a ruling, then I think that there's a possibility that you can get some of that money back by talking with people. But let's say you don't get any of that money back. Walk away. That's my advice.
And to be honest with you, most people, unless you find like that one person, most people don't want to litigate. Everybody thinks you want to sue and I'm going to sue you. Litigation costs money. Okay, let's just be very clear. So when this seller has a conversation with his lawyer, he's going to become a lot more flexible, a lot more quickly.
Okay, in your stabilized multifamily properties, what are you seeing for DCR? Are you concerned that lenders will enforce DCR covenants?
I think they have got so much bigger issues to deal with. I think that's not even on their radar right now, quite frankly, because what's the point of taking an asset where a loan payment's being made and now declaring it to be a toxic asset? That doesn't help them.
No lender wants to take over an asset anyways. What are they going to do? Start becoming real estate people now and stop being a lender? I mean,
if you pay your debt right now, you're their best buddy. Right. So absolutely nobody's going to give a damn that your DCR levels don't match. Now for new properties, that's a different thing, but who's buying new properties?
Yeah. Right. Okay. So let's talk about the stimulus packages. So far, have landlords received any of the $2.3 trillion stimulus? Why do we expect landlords to get funding over hospitals, states, cities, large corporations, et cetera?
Well, the why part is pretty hard. I don't know. That's above my pay grade. Well, we have qualified for that payroll protection, that PPP. I just keep forgetting.
Payroll protection program.
That payroll protect. It's such a mouthful. That payroll protection program, which is going to hit our books in May and June for the payroll.
So let's qualify that a little bit. You say we have qualified.
But the property has, not we. The property has through our property manager, who happen to have less than 500 employees on their books. Now, if this is a property manager like Greystar, or I guess CBRE apparently is property managing, then it won't qualify.
If it's over 500, like we have a property manager that has over 500 and they're not qualified to apply for that. But so yes, there are, through the stimulus package, your property manager can apply for PPP if they have under 500 employees. And then the portion of the payroll for the employees that are working on your property, it's paid from your property, but it is the property manager's staff. And then that can reduce the expenses for the next 8 weeks on your property. So it can be a great assistance. And you should all make sure that your property managers are applying for PPP and looking into that.
But that program is also, like with a lot of these things, that program isn't most efficiently run. So a lot of people have applied, haven't qualified, people are in queues. So your property manager might have applied for it, and in all honesty, they might not have received it. So it's not like they're doing something wrong.
Right. Half of ours have received it and half of ours have not. So not yet. So.
Right. I do want to point out that I think that the one-time fiscal stimulus that was sent to people, the $1,200 plus, money for their kids, isn't, in my mind, a bigger deal than PPP, because that is national. Pretty much everybody that lives in one of our properties, as if they're not an illegal, immigrant, they receive that money. I think that there's a lot of evidence from the past to show that once people finish buying food and paying for Netflix, the next thing that they're going to do is pay their rent. And in my mind, at least they'll pay their rent now, because I don't think that the average person that lives in a Class B, Class C community understands just how bad this system is, just how close it is to a crash. To them, they think that May and June are going to be normal, that life will get back to normal. So when he gets this money, he says, what do I do with it? Okay, I'm going to go buy food and pay for Netflix. And now I'm left with a certain amount of money. My landlord keeps haranguing me. I'm going to pay them. So I think we definitely get a substantial amount of that money coming in. And then remember the unemployment programs, the state and federal programs, I think we get some of that money as well.
I agree. So what will happen if the tenant's not paying rent and can't meet the property can't meet the pro forma of 12% return as promised to investors every year?
Well, that 12% is maybe according to your deal, because first of all, there is no return that's promised, number one. There is no return that's promised. There's returns that are targeted. Those are two very different things. And look, if you don't hit your pro forma, well, you don't hit your pro forma. I mean, there's just no two ways about it. Right?
Yeah, I think the question almost is frivolous. At this point, no reasonable syndicator is distributing to investors. The expectation that we're setting is we're probably not going to distribute for the rest of the year. People have called me and said, what happens to my money? And the answer is, well, right now I'm in principal protection mode. My job is to make sure that your principal doesn't go away. Do not expect any distributions from us for the rest of this year, and it might last longer than that. Just be aware that we don't think that at this point we are going to spend a dime. Even if we had a dime of profit, we wouldn't give it to you. We would put that into our operating account and hope to God that it lasted as long as we were going to need it. So I think this is about resetting expectations for investors. Have conversations with them, send emails, send videos, do what is necessary, but reset expectations that in a way you're lucky, because if you invested in a syndication, we still think the principal's there. So what you've lost is your dividends. Look at what's happening in the stock market. If you invested in a dividend paying company, firstly, it's going to stop paying dividend in the next month or two. And secondly, their value went down 25 to 30%. So I think you're better off in real estate. But I think any expectations of profit or distributions this year are extremely unreasonable.
Yeah, and maybe just to add to what Neal said, it'd be really important, just to emphasize one thing you said, it would be irresponsible for any sponsor to pay a preferred return even, or any form of distribution to equity investors in the current environment. Their job right now is to maintain reserves, to hoard cash, to make sure that this property doesn't go upside down. That is their job, and it's there to protect the equity investor to protect their principal. That's exactly right.
What indicators, benchmarks should we look for to help decide when it's time to start buying as real estate investors?
Well, that
How would
depends
you
on the
know?
market. That depends on how much money you have, how long your patience is, and what markets you're investing in, and what are you buying, right?
So
Look,
what indicators, benchmarks should we look for?
so look, it depends. Like, are you more of an IRR investor? Are you more of a cash on cash investor? Do you have a blended outlook on these things? What is your time horizon? Are you a guy who's going to come in, try to, whatever, fix and flip this in 1 or 2 years? Or do you want to hold this in 3 to 5 years? My point is telling you when the bottom is, right? Like, this is the exact moment of the bottom, or this is the exact moment of the top. So this is the exact moment to sell. This is the exact moment to buy. Yeah, nobody knows that. What you have to know is, what are your expectations going forward? And do the assets you're purchasing, do they match those expectations? And do you give yourself a margin of safety? After that, I mean, if you're expecting a magic pill, somebody to tell you, okay, go or stop, it doesn't really happen this way in the real world.
I would add to that I think it's premature to even ask that question. It is, at this point, far too premature. This is still developing. We're at the beginning of this process. We're not in the middle. And you yourself will be able to give yourself a better answer 60 to 90 days from now. But I don't think that there's anyone here, I don't think there's anyone in real estate that can give you an accurate answer, because this is so unprecedented in its scope. Nothing like this has ever happened in the modern world economy, not even to a single country. It's so unprecedented. So that at this point, to start thinking in your mind about where you think you're going to start to reinvest is premature. I think what you really have to understand is, this is a time to stop. This is a time to research and let this time pass, so that we can get to a time frame where we can think about investing again.
One of the big things about the current environment, which no one's really talked about yet, is this notion of counterparty risk. You can look at your balance sheet and you can say, I'm lending somebody some money, so it appears as an asset on my books and it appears as a liability on their books. But if they don't pay, now that liability or that asset on my books has gone toxic, which means it cascades onto my liabilities and it dominoes on down the chain. We haven't even begun to figure out where all of these linkages of counterparty risk exist in the financial system. So until we get close to the bottom of that, we aren't going to know what the state of the financial system is. The banks are saying, okay, we're sitting on 1.8 trillion in reserves and the Fed's got our back. Meanwhile, the bond market looks like it's ready to implode. And the banks are saying, well, okay, some bond investor lose some money, but we, the banks, are fine. I don't believe that's true. It just can't be.
No, it's an interlinked system. You cannot have the bond market implode. That 1.8 trillion is going to look completely inadequate as we get to the point where junk bonds start to default, and then followed by the BBB bonds start to default. And then you're going to see municipalities default, and so will healthcare systems. Yeah. So as you start seeing that wave of defaults, I don't think, I know 1.8 trillion in a good time. I mean, in February, our banks looked like they were more capitalized than at any point in history. It was like, wow, this is amazing. But I mean, this is like a meteor hitting the earth, right? Nothing like this has ever happened. So no one actually designed a financial scenario for the kind of liquidity that's needed today. And so it doesn't exist. So we'd have to muddle our way through this.
So there's a couple questions in the pile about 1031s, and what to do with the 1031 and what are the current rules. Well, you can look up the rules online, but the deadline has been extended to July 15th. And who knows, they might extend it past that. But another option that we didn't have a few years ago with when you sold a house that you now have is, if your 1031 is not successful or you're not able to find anything, you can instead do an opportunity zone, which gives you 180 days. So you should be looking at both of those options for you in terms of, and you should talk to your CPA so you understand your tax consequences for each one based on which state you're living in, and know that you're in a fortunate position because you've got options. If this happened a few years ago, you didn't have opportunity zone as an option. So you need to do some research, and please include your CPA on that research, is what I would say.
And I did want to jump in since we're at the 1 hour mark. I know we've got 500 people listening, but I wanted to give, to ask Omar and Victor a little bit more about, how do our viewers, the 500 people that are listening, learn more about your company? So, Omar, tell us about Boardwalk and what is the easiest way to learn more about your thoughts and follow you?
Well, you can go to our website, boardwalkwealth.com. So that's BOARDWALK wealth.com. There's right on the front page, you can put your name, hopefully you know that, and your email address and how you found out about us. And then you click and you'll be added, you'll get an automated email. It's a double opt-in. So you just have to verify your email address and boom, you're added to our mailing list. And you'll hear my profound thoughts every couple of weeks.
Well, actually, Omar, I have to say, Omar's newsletter has some very interesting and profound thoughts, and some that are very zingy and humorous as well. So it's definitely worth reading. I read all the newsletters that he puts out. Victor, tell us about you. I know, we've listened to your podcast, so tell people about your podcast, but also tell them about, how do they get in touch with you apart from the podcast?
Sure. So the podcast is the Real Estate Espresso podcast. It's a daily show 7 days a week. It is literally your morning shot of what's new in the world of real estate investing. So the weekday shows are 5 minutes, just me. The weekend shows have guests, notable people from the world of real estate investing, and they run a little bit longer, 10 to 15 minutes, but it's a short form show and love to be engaged with you in a conversation literally every day. In terms of how to get in touch with me, best way is through my website at victorjm.com. That's victorjm.com. And feel free to get in touch. Love to have a chat.
Awesome. Back to you, Anna.
Sure. So a couple of questions about exiting. So we've talked about income and whether you're hitting pro forma or not. But what if the exit strategy that an investor group was told is that it's year 5, you're supposed to exit this year. What do you suggest that the sponsors on that deal do? Do they proceed to exit?
Don't exit. Number one right now. That's a short answer. The long answer is you can refinance. So at least you take, hopefully, even if you don't take some chips off the table, so basically you just swap one debt for another debt, hopefully you get a lower interest rate, right? But what you've done in that process is you've taken our duration risk from the table, right? So you've extended the loan out. Hopefully you can keep making those payments because all you have to do is live to fight another day. As long as you can do that, you're doing pretty good right now.
And I think if you're on a bridge loan and don't have the ability to refinance at this point because your property doesn't reach that criteria, talk to your lender. Many lenders are initially going to say, I don't think you meet the criteria for an extension. You're going to go back to that lender 30 days from now and he's going to say, I don't think you meet the criteria. You're going to go back 60 days later and that lender, I guarantee, is going to say, okay, let's take a look at it. Why don't you put an application through? Because at this point, lenders don't want properties back just because of extensions, right? An extension is not a big deal for them, but not yet. I think lenders are still holding fast to yesterday, and their mentality is still what it was in February. It's going to take a few months for it to adjust. But I don't think anyone needs to lose their property because you have bridge debt and you're not eligible for an extension because you're not at the DCR. I don't think anyone's going to lose a property.
By the way, on that extension, just don't take the 1-year extension. If you've already got the person there, they're willing to negotiate. Say, look, let's find a way. Let's extend it to 1.5 years, 2 years in one shot. So what you don't have to do is you don't have to get back on this dog and pony show in 12 more months, right? If you're trying to buy yourself time, buy real time, not 6 months, 3 months. That doesn't really cut it. 2 years, go for the kill.
2 years, okay. Okay, we always have this question that comes up in the town hall because Neal and I are in the Bay Area. We have a lot of Bay Area investors. So what about the Bay Area? Do you think the bargains are going to be here coming up for the single family homes? Is it time to buy in the Bay Area?
It's definitely not time to buy. I think that there's going to be more bargains in the Bay Area than any other place. The Bay Area was a market priced for perfection. It was priced for perfection in so many different ways. And I think that what you'll see is that the sub 800,000 market in the Bay Area is going to do well, which is considered the cheap part of the Bay Area market. And the 800,000 to 2 million market is going to have a meltdown. Is it time to buy? No, because it hasn't started going down yet. I mean, if you can't do open houses, how do you get a market to actually go down? So the answer is the Bay Area debacle is going to play out over a year. It's not going to be, so I don't think you should buy anything in the Bay Area for the next 6 months. Just watch it drop. It's going to keep dropping. That's my, I'm on video, so I'm getting recorded here saying, yeah, the Bay Area market is going to suffer, and it's going to suffer more than a lot of the other markets. I mean, you look at Atlanta, the average home is 200,000. You look at the Bay Area, the average home is what, 700,000, some crazy stupid number like that. It's unsustainable. People get laid off, can't pay anything. So I think that you haven't seen the white collar layoffs yet, but if the blue collar layoffs happen and you get 26 million Americans laid off, the white collar people will get laid off next. And when they do, they're going to stop paying their mortgage. So big debacle coming for the Bay Area. So, and by the way, New York might be worse.
Absolutely.
So Neal, we have a few people asking, since you're talking about a very severe 3 years potentially, what does that mean for Grocapitus investors and our portfolio? What are you seeing there? What are you projecting?
We're not projecting anything. We're watching the market and trying to understand our place in it. Any projections that I might come up with today are going to be nonsensical because we are in an unprecedented situation. What we are doing is doing what are considered to be prudent things. Stop paying distributions, talk to our lenders constantly, talk to our investors 3 times or 4 times a month instead of once every 2 months. We're doing all of the prudent things. But we are subject to the market. We're subject to market risk. We're clever in the sense that we know we've hedged our bets in lots of properties and have lots of cash, and we're sitting on that cash. And when it comes to negotiation with lenders, we know how to play this long game. We're going to basically be haranguing our investors. Yesterday, I was talking with, and I was
haranguing our investors.
Oh, sorry, haranguing our lenders.
Let's not harangue our investors.
Yeah. So the answer is everything's on the table. I mean, we might need to do cash calls. Our goal at this point is simply that we understand that this will take a while. And I do believe, and everything we've said really in the last 50 minutes has been negative. So here's something positive that I want to say. One of the potential scenarios to get us out of this is a massive coordinated injection of liquidity from banks and Congress's governments throughout the world, right? That they're talking about. There's actual conversations going on in Basel, in Switzerland, where people are meeting and saying, how about we inject $50 trillion into the world economy? $50 trillion, because I think that's what it takes. $50 trillion is the right number. That might happen. If that happens, 3 years from now, Grocapitus investors are going to be very thankful that they invested in our project. But how we're going to get from here to 3 years from now, I don't know. It means a lot of sleepless nights for us. It means a lot of sleepless nights for you because we're in this together.
Let's see. Please speak to property markets heavily influenced by oil and gas, like Houston and Louisiana, Lake Charles. What about those markets?
Why don't I take that since I'm very
Sure.
active in those markets? So I would separate oil and gas because they're very different. And I would separate where you are in the food chain. So for example, if you're at the exploration end of the food chain, if you're in North Dakota, where you really need a certain price per barrel in order to put a drill bit in the ground, then yeah, those markets are going to really hurt. Oklahoma, big time. If you are at the other end of the spectrum, midstream or downstream, where you're at the consumption end, I think you're going to do better. A lot of the investments in the petrochemical infrastructure are designed to span economic cycles. So if someone's building an $8 billion liquefied natural gas plant, it's because they ultimately see demand for that over a long period. Today, for example, much of Western Europe gets its natural gas via pipeline from Russia via the Ukraine. From a geopolitical stability perspective, they'd like to have a second source of supply. That's why Spain is buying natural gas from Lake Charles, Louisiana, because they don't want to have to buy it from Russia. France, Italy, many of these other European countries are getting natural gas from the US because they want that geopolitical stability. So, these investments are continuing. I own an RV park specifically for workforce housing in Lake Charles, Louisiana. We had 29 people move in the last week and a half. So there is activity. The big hiring numbers are not happening right now, but in the Houston shipping channel, there are 6 refineries that supply a quarter of the gasoline in the United States, 60% of the aviation fuel, 53% of the diesel, those refineries are still operating. They're going to shut down 2 of them in the next month to do a turnaround, to do planned maintenance, but they're all still operating. Now, is Houston going to suffer? Absolutely. But it depends where you are, midstream and downstream versus upstream.
Neal, you want to jump in
We're
on that?
in the Houston market, so I want to jump in. I think that it's about also the percentage of your economy that is really tied to oil and gas. So you can go to city-data.com or a bunch of websites and get a pie chart for the area that you're talking about and look at what that percentage looks like. Houston is about 8.6%. 8.6% of the jobs are tied to, oil and gas. And I think some portion of those jobs are going to be lost. I believe that the number is higher than 8.6 because I think there are some ancillary jobs that are tied back to those 8.6. So I'm going to be conservative and say 15% of the jobs in Houston are really tied to oil and gas, even though the pie chart only shows 8.6. Out of those 15%, I think you're going to see 20% of those jobs lost over the next year, or maybe even 30%. But the point is, unless we get into a world-ending debacle, which I don't think that the politicians are going to allow, the feds are going to allow, in the end, the United States is going to go back to where we use oil, we use gas. So today in China, we're using about 85% of the oil that we were using in February, in December, right? Because China was about 2 months ahead. So 90% of that oil still needs to be pumped out of the ground. 90% of that oil still needs to go through the petrochemical system. So what happens is that the stocks of those petrochemical companies are going to get hit really badly. They're not going to do new refineries. They're going to lay off people. But you cannot push 90% of the output through and lay off all of your people. So that 15% of people that work in Houston, I can agree that 1.5% or 3% of those are going to be gone, right? But if Houston loses 3% of its jobs, that still places it in the upper 25% of markets in the United States in terms of overall job creation. And it's going to lose those jobs for a year and a half. Oil demand and oil supply is largely inelastic. There's not much that you can do with it. The world needs 90 million barrels a day to 100 million barrels a day just to function and function properly without any future growth, by the way, because we're still growing population and that's not going to change. So to me, I think you're going to see a hit. You're going to see a hit that's substantial, but I don't think that hit is 2 years from now or 3 years from now, unless something horribly goes wrong with the world economy.
Yeah, let me just add one more thing, because I agree with Neal's 15% number. There's 6,000 independent oil companies in the United States. The projection I saw from a webinar I attended last week with the economic development folks for the Port of Houston, he suggested that a significant portion of those 6,000 oil companies are going to go bust in the next 90 days. That oil is not going to disappear. It means it's going to change ownership, and that debt is going to get a significant haircut.
Yep.
Right. So the oil is still going to be there. The ownership is going to change, and maybe we'll start to see some more consolidation in the oil industry.
And that may not be a bad thing. I mean,
right.
The oil industry hasn't made much profit, especially the shale industry hasn't made much profit in the last 5 or 6 years. So what you're seeing is actually the end of one cycle and the beginning of another. I can tell you oil companies are worth money even if they're going bankrupt, because their equipment and their wells are worth money to the next guy in line. So banks, when they go out of business, another bank takes over their deposits, they take over their customers. The same thing happens in the oil industry. Because in the end, the bottom line is this: oil demand in the world is inelastic. The price of oil, if demand goes up by 5 million barrels on that 100 million, the price of oil goes to $200 a barrel. That's how inelastic it is. So when we get demand coming back in, even if it's not at 100%, that 90-95% of demand still requires pretty much all of the oil infrastructure of the world to function. And so those jobs cannot go away.
Omar, can you talk about communication with tenants? What are you saying to your tenants, or what are the property managers? What are you advising? What are best practices for communications with tenants?
Well, number one, over communication is always better than under communication. Number one, but the big overlying features have always been the same. We've been doing this, I think, pretty much from start or slightly before this, when the initial thing started happening, is You be sympathetic, you be empathetic, because it could be you, number one. Then you make them aware of all the opportunities, state, federal, and local, that are available to them. In our particular case, what we've also done is that the senior citizens on our properties, we're providing them hot meals free of charge, because they're one of the most vulnerable groups, so we don't want them leaving the house. Free of charge, we're providing them hot meals every day for the past, now it's been more than a month. For our tenants with children, what we've done is we provided them, like toys and stuff like that, just because kids are home. So basically they have a way of basically keeping these people occupied. A lot of the things that you're going to do right now aren't necessarily going to be financial in nature. They're more to be buying goodwill and maintaining that goodwill. Because look, if you're on not antagonistic terms, and then your property manager says, look, Jim or Bob or whatever, look, I know you owe $1,000. How about you give me 500? We got to pay our bills. That is still a conversation that's going to happen, versus everybody's at each other's throats, and then you try to demand money from somebody, even though you're right, you're not really going to go along with that conversation. So right now, it's all about doing even more than usual, making sure you do these small little things, and then ensuring that you do put in plans. So anytime there is a tenant coming in and saying, look, we can't pay you, you give them alternatives, like a payment plan, or you direct them to resources, and then you make sure you follow up with them. Hey, did you get this? Can I do anything for you? A lot of this is basic common decency and sense, that sort of stuff.
I think it goes a long way. That decency goes a long way today, because that tenant for the first time has a choice to pay you or not to pay you. The tenant knows you cannot evict them. So I think the decency, the connection, the creation of a community, the we are in it together feel today is actually, it's always been important, but today it's ridiculously important.
Yeah, and making
it always pays to be it always pays to be a civilized human being, right, guys? Let's just be honest.
Right, and adding value, right? So our property managers and our asset managers, we want to be continually adding value to our residents. And if our residents understand that the money that they're paying for rent is going to pay for staff and maintenance on where they live, then it just makes sense. Like, why is it fair for them not to pay rent? Those people have to get paid somehow. Yes, there's PPP, but fair is fair. I mean, everybody has to do their part for us all to get through this.
Guys, and you're going to have people who are going to game the system. That's always going to be the case, but you've got to look at the big picture.
Yes. So I just threw up a poll. We'd love for you guys to answer it. Well, we just click on those little buttons and tell us about you. And I'm going to ask some more questions now. Let's see. What do you think about seller financing deals in general right now? Is this a good time to look for seller financing deals for 10 to 15 units, for example?
Well, it depends on how much money the seller is financing, right? What portion of the deal are they financing? Are they financing all of it? Are they financing a smaller portion of it? It really depends. So I think it's case specific.
Yeah, I think it's case specific as well. I think the same rules apply about seller financing today that apply under normal conditions. Oftentimes you'll see a seller offering seller financing for a property that won't finance any other way. And if that's the case, there's a clue.
Mm-hmm.
Do you think tech companies can help bail out the economy with their excess liquidity? And let's expand that beyond just tech companies to companies that have excess liquidity.
No.
Anyone?
Short answer is no. What do you think these people are going to do? Do you think Facebook is going to take its $100 billion and just go on a helicopter, and Mark Zuckerberg is going to throw it all over the country?
I don't think they're going to do anything to help out.
No, even if they could, they can't do anything. It's not like it's in their control.
Yeah. I think Omar's right both ways. They won't do it, and if they could, then it's not clear how they would do it either. So
yeah.
There's quite a few questions about specifics related to the EIDL and the PPP program. And we on this panel are not experts on that, but I do encourage you to join us on Wednesday. We have a webinar with Amanda Hahn and Matt McFarland. They're CPAs, and they have done and that specialize with real estate investors. So first of all, they'll talk a lot about 1031s and what that means, especially in this environment. They'll understand all those rules that we were talking about earlier. But they've also done a deep dive into the CARES package, and they will be able to answer your questions. So please join us at our Wednesday webinar to get all of the details on EIDL and PPP and how it applies, who can apply for it as real estate investors and who can't. That is our best place to do that. let's see. Let's talk a little. We've got quite a few questions about underwriting, and how are we supposed to underwrite now? What kind of sensitivity analysis do you recommend, Omar?
Well, that depends how much money you want to lose and how quickly you want to lose that money. Look, the point is underwriting isn't going to do anything right now. What you have to basically understand what is, say, replacement cost in your market, number one. So what will it cost to build this new thing up? What and how flexible is the seller trying to sell you? Because any number, anything you try to do right now, is as of today, because we're, like Neal and Victor said, we're at the start, right? So we don't know how long this is going to take. Any number you come up with is arbitrary. So what it basically depends is how long is your time horizon, how flexible is the seller. So for instance, can they guarantee income for, say, a year? And if they don't, like, what is the repercussion on it? And how much cash do you have in the bank to withstand any shocks to your purchase? So those are
I would like to take this.
Answers.
Yeah.
More qualitative than quantitative.
Yeah. So I'm gonna beat up the underwriter. So you're an underwriter, right? So you underwrite stuff. Yeah. You put stuff in Excel and you say things like, I'm very conservative. How can you say that today?
I'll tell you right now how I can say it.
I mean, how can you possibly use the word conservative and the word underwriter in the same sentence today, having absolutely no clue what the price of property is going to be in 6 months?
I can tell you how I'm going to do it.
Sure, go for it, Omar.
Because I'm not buying a property right now.
There you go. I mean, that's
I'm not buying a property,
answer.
so I'm not going to go out and tell you this is conservative or liberal.
Yeah,
right?
No benchmarks exist because we just demolished every benchmark that ever existed, and we have to create new ones. And for those of you that think we're going back to the previous benchmarks, you probably were asleep for the last 80 minutes.
Let's talk about markets then. Neal, you're well known for having data points about how to pick markets. How would you layer, what would you layer on top of those to evaluate what markets to focus on as we eventually come out of this? How do you add Corona into it?
Yeah, I've been thinking a lot about that. I get that question a lot. So here's 5 rules. None of them are positive rules. You've already seen my positive rules if you've taken the location magic classes. So here's 5 rules for you that are negative rules, and I think that those are the only kinds I can give you. Number 1, don't invest in cities that are tied to tourism and entertainment. San Francisco, New York, Orlando, New Orleans, Honolulu, Los Angeles, Miami, Vegas. These are tied to tourism and entertainment. They will come back much, much slower. The recessions there will be much deeper. Number 2, do not invest in cities tied to the cruise ship industry. Fort Lauderdale, Miami, and to some extent, New Orleans. But those 2 are going to get hit very, very hard because that's a massive industry that I think has, at this point, a very dark future for the next 12 months. Cities that are tied to gambling revenue, right? So you got Reno and Atlantic City, Vegas. These are going to take a very long time to come back. Cities that are tied to oil, we already talked about that. Look at whether they're pumping oil out. Are they part of the stream? I think that one's more short term. So I think that's more of a 6 to 12 months. But you are picking cities, might as well pick others. And then I have one. The 5th one that I have is not cities, it's states. Mm-hmm. States that are most liberal at this point, you need to stay away from. California, Massachusetts, and Oregon are talking about rent strikes and rent forgiveness. The city of San Jose is about to vote on a bill to force the landlords to reduce rents by 25%. So California, actually no, that one was to just get rid of rents for 12 months. Chicago is introducing a bill saying there should be no rent for 12 months. The state of California is saying all rents to be reduced by 25%. So I warn you, stay away from over liberal states, Massachusetts, California. Just Google states that are most liberal. I think that they're going to do some really crazy shit that you would not even imagine in February.
Yeah. And I was reading a report this morning from Marcus Millichov about new construction, and the report was talking about how new construction in most major metros is not happening, blah, blah, blah. And I'm thinking to myself, geez, it's happening in all of ours except for one that's in New York. Right. But all of our projects are going
New York, right?
Yeah. Because
and what's funny is New York tagged construction.
Yeah.
They tagged, this is what happens in a lot of liberal states. By the way, I'm a liberal Democrat that only invests in Republican states for a very key reason. But bottom line is, so New York first said, construction is essential. Then they put so much red tape on us and made it so difficult to do construction that we willingly walked away from our construction site.
Let's see. At this point, I'm gonna have our panelists take a look at the questions because we're reaching our end here. And I'd like you to each pick out one question that you'd like to tackle.
So where are we clicking the Q&A box?
Yeah, the Q&A box. There's still
so guys, I'm going to start from the bottom. Nobody start from the bottom, okay?
I'll start.
Just pick out. I mean, there's a lot of questions that we've already answered that there's just somewhat duplicative of the duplicative concepts. But then there's some things that we just haven't gotten to yet.
Elizabeth wants us to pick the Utah question. Let's see if we can find the Utah questions.
Well, we do have a question about Phoenix. What do you think about the Phoenix market? Once we start talking about markets, everybody wants to know about specific markets.
So markets that were extremely hot are the ones that will cool down the most, right? So Phoenix was considered to be the hottest market in the US, so it has more range to cool down than some of the other markets. That's the honest answer to your question. Fundamentally, I think Phoenix has a stronger economy than a lot of different places. And so it should do well, but coulda, shoulda, woulda, I mean, it's kind of hard to tell. So I think that there's going to be some pain there in the Phoenix market for sure.
Okay, there's some questions. Okay, obviously I'm going to mash up a lot of questions.
Yeah,
so
that's
there's not going to be like one question, right? Okay. There's a lot of people apparently who've, it's really funny. In the last 2 months, a lot of people have become epidemiologists and now they're becoming macroeconomists. And most of these people don't have a college degree. So in the questions, no offense to anyone, I see a lot of questions regarding the Fed and what people think is going to be deflationary, inflationary. Is it the end of the world reserve currency for the US dollar? And is Bitcoin, of all the things in the world, going to be a good investment? And I can safely tell you guys have way bigger problems to deal with than this problem. Okay, you survive this thing. First of all, there is no hyperinflation because you don't live in Zimbabwe. Please, Americans have to get this out of their head. You guys are obsessed with the end of times. Okay, I have lived in a poor country. You're not a poor country. Okay, that's not going to happen. Bitcoin is not going to happen because we've already seen basically it has no store of value. It's basically a crapshoot. It's essentially me selling you a bunch of, I don't know, rocks and saying they have value. And secondly, what do you think the Fed is going to do? You're caught between a rock and a hard place. The Fed's mandate as a government agency is to ensure that you have a soft landing. Because if you don't have a soft landing, what you have is people on the streets without food and a repeat of the Great Depression. Do you want to go through that? So my point is, a lot of times it's very easy to sit on the sidelines and criticize somebody. But the person who's in the battlefield, who's actually going through a lot of these problems, you have to look at it from the administrator's point of view and see that they have to juggle multiple responsibilities. And your immediate concern is not everybody's future, or my immediate concern is not everybody's future. So the government has to take a balanced and holistic approach that is going to be more than 2 days long.
I want to take Evan Wise's question. Evan's one of our investors. He says, how secure is cash now? With $3 trillion in added money being printed, how will it be paid back? You know, treasuries, taxes, inflation, there's no free lunch. Everything you said is correct, but I still think cash is king. Yeah. Because I believe that we are in a financial market where if there is inflation, a solution will be found where the rich people will benefit. At this point, and if rich people benefit, cash will still be king in that new environment. It may be worth less than it's worth today, but you'll be glad you held on to it. Cash is still king.
Yeah, you're not going to take a 50% haircut on your cash overnight.
No, other people will. Yeah. Probably the ones on Social Security will. Somehow a way will be found for you, the rich people, not to take a big haircut. As long as you've got money in your hand, that money is worth as much today as before. By the way, I want to address Bitcoin. If you're one of those Bitcoin fanatics, and I've been in that Bitcoin boat, on one side of the boat, the other side of the boat, outside the boat. Look at what Bitcoin does today. Do you need further proof that Bitcoin is no different from stocks and real estate? Yeah. Its decline has matched the stock market. It is a speculative medium where the vast majority of the people are speculating just like they're speculating on stocks and real estate. So if its curve is exactly the same in the middle of a pandemic, for 10 years, people have been saying, when the next pandemic hits, that's when Bitcoin is going to go up to 100,000. And we've seen the exact same decline in Bitcoin that we see in the stock market. It is a speculative medium, no different from any other kind of speculative medium. Until you can find all of the people that are speculating on Bitcoin, bring them into a room and shoot all of them, it doesn't become what it was meant to be.
Victor, do you have a question you picked up?
I'm going to synthesize a question from a couple of them, and it's kind of picks up on what's been talked about here. In every single downturn, four things happen, and I can't take credit for this. I'm going to give credit to Ray Dalio because he said this over the last 2 weeks. He said four things happen, and I think he's absolutely right. Number one, there is a pullback in spending, what's often called austerity. Number two, there is a repricing of assets, meaning there's debt forgiveness. So someone's going to take a haircut. Number three, there's going to be a transfer of wealth. And number four, there's going to be some impact to the monetary system, either the printing of money, clearly the debasement of the currency, meaning the value of the currency is going to fall, and in extreme cases, currency collapse outright. We've seen that happen. It's happened in Argentina, it's happened in Zimbabwe, it's happened in Venezuela. It doesn't take necessarily, just irresponsible government, but at a certain point, the faith in the currency it is only there until it's not. And when it's not, then the bottom falls out. We don't know where that's going to be for the US dollar as the world reserve currency. Today, it's backed by petroleum. Is that going to continue? We don't know. But those four things happen. And so you really want to pay attention to all four of those. That's what I think you need to look at.
Awesome macroeconomic comment. So we are beyond our 90-minute point. So I just want to thank Anna for, once again, doing all the work in the background and putting this together. We'd love to have, you guys back, because I think that 60 to 90 days from now is going to be a very interesting checkpoint to look at all the stuff that we just spouted to see, what happens. So maybe we redo this because it turned more into a macroeconomic, event than any of the others that we've done. But thank you to Victor and Omar for sharing your thoughts. I loved how honest and straightforward and blunt this session has been, and I hope that all of our future town halls are like this. So thank you to the 415 of you that are still with us at the 100-minute mark. Keep coming. We'll do the next town hall within the next week or two. Thank you, everyone.
Very much.
Thanks, everybody.
Thank
Have
you.
a great weekend.
Have a good one. Bye.
Bye-bye.